forget about averages, forget about standard deviations. You need something else. You need a little bit more exotic math. I mean, it is a mathematical thing. It is a model and has been spot on for the last 3 months. You know, the entire reason that we have a model is to protect against our own emotions, right? Because I know very well how I felt during that entire 3-year period. In a way, that in the depth of the COVID crisis or the China crisis, you feel bearish, very, very bearish, and you're tempted to sell everything, and I think the world falls apart. That's when the model saves you, right? And the same thing is true when the model, when the price is up, and everybody is FOMOing. It's especially in the top when Elon Musk tweeted that Bitcoin tweet, and everybody was FOMOing. I was like at the high part of the standard deviation band, so don't get too excited. So even then, your greed and fear is sort of tamed by mathematics, and I like that so much. I need it because you cannot invest without the mathematical guidance, and you will be ruined by your own emotions. And by the way, I know some hedge funds, it's more than 1 or 2, that use this exact model to do this trade. So to buy when it's at the outer bands, at the lower bands, and to sell when it's at the upper bands. You could, if you do it well, it's very risky though, but you could make money trading this thing as well. It's more fundamental than we might think at the moment it is, because it looks like a fitted line, the stock to flow model. But I think the scarcity argument is a fundamental argument as well, because that's also how I started out making that model, right? Because there's other scarce assets like gold and silver and diamonds and real estate. And it would really, really surprise me if real estate, which has a much higher stock to flow value than gold and Bitcoin, for example, if the value would be lower. And likewise, if Bitcoin surpasses gold in stock to flow, in scarcity, it would really surprise me if the market wouldn't put a larger price ticket on it. So there's some very fundamental scarcity force at work here. That's what I think. And we haven't figured it out completely yet, because it's now in its rudimentary state, if you will, like put out in 2019. But I'm very, very curious what people, or maybe myself, what we will find in the future, if the relation can be tightened or even defined better. And then I also agree with the fact that, for example, the human nature will not change. So greed and fear will drive this market as well. So there's this scarcity force. There's all sorts of black swan events like COVID in China, but there's also greed and fear. So people will be greedy. And when they go 2x or 3x, some will sell, but others will think it will go 10x or 100x, and they will stay and buy, and then leverage, yeah. And the same when we go down, then people will be. There's people bearish. Oh, it's all over. This was the top. We crashed to 64, or where are we at the moment? But look at what you're saying. We crashed to 64. That's a crazy price, right? We'll be saying we crashed to 100,000 a couple of months from now. That'll be fine. But the greed and fear, I'm sure, will be there. People don't change. Some people say that's a wide range, but if you look at the y-axis, you see 8 orders of magnitude, and that's enormous. 8, if a model is right over 8 orders of magnitude or 7, that's crazy. And I have investors, big investors, traditional investors, right? Institutional investors that came to Bitcoin and that came to Bitcoin and stayed there because of this chart. Maybe not so much the model, but just the price chart. Seeing this exponential growth over 6 or 7 orders of magnitude in 10 years, over that long period, that tells you something is going on. There is a sort of constant growth, adoption, or whatever there. And investors, traditional investors like me, have never ever seen that in their entire lives. I mean, the closest thing is maybe Tesla or Google and Facebook. And that's a bit of a wrong example as well, because big tech stocks were very volatile in the beginning, so just after the IPO. And then the volatility decreased and they just went up and up and up because of adoption. And with Bitcoin, it's slightly different because the volatility doesn't really go away. It's still a 80 to 100% implied volatility asset. Those implied volatilities, you can measure those from the option prices. That's what the option market calculates for the volatility. 100% volatility is crazy. There really is some underlying trend going on, and an institutional investor can watch for hours at this chart and shake his hand and say, well, this isn't possible. This cannot be. And it's there. And with that high volatility as well. So the volatility sort of blurs everything on smaller time scales. But if you look at this chart over 10 years, it's just the most amazing thing you've ever seen as an investor. But my model is slightly different because the 200-week moving average and frankly, most technical analysis is taken from normal markets, equity markets, foreign exchange markets. And Bitcoin has this very specific nature, this exponential nature that we talked about, that it goes over 6-7 orders of magnitude in 10 years time, and with a lot of volatility as well. It's not normally distributed at all. Forget about averages, forget about standard deviations. You need something else. You need a little bit more exotic math. Let me say this also, right? It's a floor model. It shouldn't be under those measures, those numbers. So 98 for November and 134,000 for December, unless there is a black swan, of course. I mean, it is a mathematical thing. It is a model and it has been spot on for the last 3 months. I could be wrong because there could be a black swan event. There could be a thing, but at least to make it very concrete, if we don't hit the 98,000 in end of November, that would be a first on this specific indicator in the entire history of Bitcoin. So in the entire 11-year or 12-year period. That's why I can be so confident about it. And of course, it's in line with stock to flow prediction, right? So the 135,000 end of this year would be crossing that white line in the chart you show right now. And it would be exactly in line with the stock to flow model. And so that gives me even more confidence that in both the floor model and the stock to flow model, that there's both two clocks telling the exact same time. So I think the greed and fear in people will stay. That's causing the FOMO tops and the crash bottoms. And that's amplified, of course, by leverage, people that lend money to invest in this already very volatile and high return asset, which is very stupid. You should never ever do that. That's you're certain you take it to hell, you will get liquidated. But it's fun, of course. That's basically it. So I think indeed that it will not be a super cycle just yet, but it will have a FOMO top, and that can be even higher than we might expect, right? Because we look at this chart, FOMO top in 2017, 20,000 was about 3 times above the 7,000, 7,500 model line. If we would project that on today's stock to flow value of 100,000, you would get a top of 300,000. But then if you look at 2013, it was like 10x above the model line. So that would imply a $1 million top in, say, 2022, which is unthinkable right now. But we did it in 2013 and actually in 2011 as well. So it wouldn't be it wouldn't be impossible. But I certainly think that after that, the fear kicks in, something happens, some people take profit or are going to hedge themselves with futures, and the whole thing starts tumbling down and we crash back.
What milestones do you see as being the most impactful when we talk about the acceleration of hyper Bitcoinization?
I mean, El Salvador was the first sovereign state to recognize it and even hold it in their treasury. And I think the next milestone is really to look at a wealthy, industrialized nation that holds it in their sovereign wealth. That's interesting, because then you got to set a table at the sovereign level who are going to bet for Bitcoin against like banning it or regulating it out. I think that's important. It'll add comfort to a lot of people coming in. I think in terms of a metric, the next milestone really is the distribution. To have that distribution be less concentrated and start to reflect something akin to what we see within the fiat world, and then further distribute. I think that's one of the most important things. Everything within Bitcoin is very reliant on decentralization, and decentralization of the wealth base is just as important. That would be a kind of non-visible political milestone. It's non-political milestone. It's just a metric where we just cross, and like now it's more spread than fiat. And then, hopefully it continues to spread and we have a better distribution of wealth in the world. I mean, that's my hope. Let's see how it works. Currently it's more just concentrated, but I'm seeing every year that the whales sail down and eventually we'll have succession. The original rich whales will eventually pass on in their inheritance to the next generation. And so, I think we'll get there. Plan B.
Predicting is difficult, but predicting far in the future is even more difficult. One thing I learned is that even 2 years into the future is so difficult. If you look back 2 years, right? If you look back at the end of 2019, I would have never predicted COVID or the whole thing around that. That's not even 2 years ago. What will happen and what will be the big accelerator for Bitcoin and a lot more things with it is something we don't know yet. Something that will pop up next month, tomorrow, 6 months from now, that will alter the entire scene. It could be climate change. It could be a cyber security leak scenario with attacks, and then all the banks, all the money is gone. And of course, Bitcoin is the only network that cannot be hacked and attacked. It's something we cannot even think of right now that will trigger that hyper Bitcoinization.
Do you think about tail risks?
Yeah, tail risk.
Like I think it's a tail risk that Bitcoin doesn't succeed. I think it's more like it's already at a level of success where it's going to get to the next level. But the tail risk is if something breaks and then the next day it's gone.
Yeah. The tail risk. Yeah, there is tail risk. But I agree with you. How I see it is Bitcoin is the better money. It's the better store of value. It's mathematically, thermodynamically, it's the best there is. So it must succeed. It has to succeed. It can be stalled. It can be sabotaged by political things, by military things. But it is physically or thermodynamically, it's mathematically, it's the best thing there is. So it would be like saying keep saying that the Earth is flat while it is round. You cannot hold that ball under the water. It has to pop up. So I fully agree. Bitcoin will go higher and higher, and there is still risk.
We can't see it by definition, right?
Exactly. Yeah.
Yeah, what's the saying that the biggest risks are the ones you don't know, right?
Yeah.
That's it. And that's the same is true for the biggest opportunities. So I think the next trigger, it will pop up. One day we'll wake up and then there it is. Changes the whole world.
Yeah, I think I agree with that. I mean, I think that we're looking at pretty much a 4-year from now to really, have Bitcoin as a main contender on the world scene as a new money, or definitely a large macro store of value. It's interesting because the next halving brings Bitcoin to the inflation rate below gold. It gets pretty scarce. Yeah, one more. I think the when I talk about the cycles, I think we agree on the destination where it's going. I think there's just different views on the shape of the chart. Whether or not we have the painful 1 year drawdown of 80%. And I think that's the difference of it is how, and a lot of people have said, does it invalidate stock to flow? Well, of course it doesn't, because that's just based on the scarcity valuation, which doesn't change. It's just how does the price sort of meander in its shape, which is, it's a very important point for people who want to time the market and want to sell the top, I did, Plan B did for 50%. And
it's interesting, Woody. It means we're back at the risk measure point, right? It's how do we and the options in there. So will there be a minus 50 or minus 80% drop again? It's a risk thing, basically. So that the endpoint is, I think, clear. It will. The trend is clear. It will go up. But how will we get there? And will there be minus 80% drawdowns? That's the
exactly.
question.
It's all about the risk. It's all the downside and how much you're willing to withstand. And I think there's more than that. It's there's times when I'm trading and the trade is going against me. And I know it's going to swing back because I've got the fundamental data that's very, very strong. And I'm it's going to swing back, but I will sell down my position to mitigate the downside risk. And the reason I do that is not because I don't believe I'm going to win this trade. The reason I do that is because I know ahead of time, if it goes below a certain level, I won't be able to stomach that level downside whilst keeping a clear head. So I'm actually proactively, I know my risk tolerance pretty well, having traded for so long, and I'm going to take some money off the table, downsize the risk so that if it hits lower, I'm really going to make a less emotional, I'm going to make a decision more rationally rather than out of fear. So like, it's like that, I think it's not only understanding risk, but it is really much understanding how your behavior is going to happen. Like how is it going to play out with the road ahead, which is really important.
And one thing I'll be looking at like a hawk is the option markets that we talked about before, because the option market is a risk market, is a volatility market. That's basically trading volatility as an asset. And I pulled up the numbers right now for September options, September next year. So a year from now, almost, the implied volatility is still above a 90%, between 90 and 100% implied volatility. And I guess if or when the markets, because both of us can be right? If the super cycle, the hyper Bitcoinization sets in, and the market is convinced it will go without those minus 50% or 80% drops, then that implied volatility in the option markets will be the first signal, the very first signal, because they are directly trading that as an asset, where the implied volatilities will drop. That's what I think. And right now they're at 90, 100. So that's really thank you very much, Seyfedin. And I feel like a sorcerer sometimes, a magician. But
we've had you here before in one of our seminars. It was almost a year ago. It was in December 2020, and you said during that seminar, you said, this model is young. The next year will be a test of whether it holds up. So I presume this test so far throughout this year has held up, in your opinion, right?
I think the China ban was kind of that set it back a little bit, put it off track, and even out of the one standard deviation band, which is rare, as you can see in the history. Although it was outside of that's one standard deviation band when I made the model in the beginning of 2019. But yeah, on average, it's very well on track, beyond my highest expectations, and I think. Yeah, crossing the 100,000 level this year, or I shouldn't say that, but or early next year, but I guess it will be this year. Then I'll be like, okay, this is it.
Yeah.
And my floor model is not the 200 weeks moving average. I just know that a lot of people use that as a floor model, and indeed you cannot predict with that model. You can just say, okay, we're now very close to that 200 week moving average, so that this must be the bottom, for example. But my model is slightly different, because the 200 week moving average and frankly most technical analysis is taken from normal markets, equity markets, foreign exchange markets, and Bitcoin has this very specific nature, this exponential nature that we talked about, that it goes over 6-7 orders of magnitude in 10 years time, and with a lot of volatility as well. It's not normally distributed at all. So forget about averages, forget about standard deviations. You need something else. You need a little bit more exotic math. And Nicholas Taleb wrote a lot about this kind of math. It could be power laws and fractal dimensions, Hurst components. That's the area that I took some measures from, and that allowed me to predict not far in the future, like stock to flow, but at least a couple of months out in the future. Let me say this also, right? It's a floor model. It shouldn't be under those measures, those numbers. So 98 for November and 134,000 for December, unless there is a black swan, of course. I mean, it is a mathematical thing. It is a model, and it has been spot on for the last 3 months. But I could be wrong, because there could be a black swan event. If we don't hit the 98,000 in end of November, that would be a first on this specific indicator in the entire history of Bitcoin. So in the entire 11-year or 12-year period. So that's why I can be so confident about it. And of course, it's in line with stock to flow prediction, right? So the 135,000 end of this year would be crossing that white line in the chart you show right now. And it would be exactly in line with the stock to flow model. And so that gives me even more confidence that in both the floor model and the stock to flow model, that there's both two clocks telling the exact same time.
Yeah. You've said before that your criteria, or one of the criteria that you would accept for the model being correct or accurate, is whether the predicted price, whether the actual price crosses the predicted price once a year, right?
Yes.
Do you still stand by that? Do you think this is like a be-all, end-all for the model, or is it just one nice to have?
No, I think it's important. It hits on the subject of co-integration, because correlation measures the fact that when the scarcity goes up, Bitcoin price goes up, and it goes simultaneously up and down. So the variance of the one scarcity has a relation with the variance of the other. But co-integration means that the real price sticks to the predicted price really close, and doesn't wander off too far, and that the difference between those two, the model price and the real price, is on average a constant. So yeah, that should happen. Otherwise, the model is will fail. So if we stay for next year, for example, or for next year, next 2 years at the current level, or even below that, the model is invalidated. It is very obvious also from this chart that in that case the model would not fit the price. And the same is true for if it goes up. If it goes to 1 million and stays there, that would be overshooting the model. Problem with the co-integration test is currently that we need 2 random variables to be allowed to apply those co-integration tests. And the price for sure is a random variable, but the stock to flow ratio is sort of determined. Not really. I mean, we cannot predict then when the next halving is exactly, and there is variability because the blocks do not arrive every 10 minutes. Roughly, you could say what the stock to flow will be a year from now, 2 years from now, even 10 years from now. And that's what makes it, the stock to flow model, such a great predictor, because you know the input variable with a certainty. But the disadvantage is you cannot apply the co-integration tests. If you do the co-integration tests, by the way, you will find co-integration, but we cannot apply the test. So that's a bit of a bummer. But what the test measures is how much the price sticks to that model. And I translated that or dumped that down as, it's above and below the black line, the model line, each and every year. So yeah, I think that's very, very important. By the way, I do think that we will have a super cycle or hyper Bitcoinization event eventually, when after the next halving we surpass the stock to flow ratio of real estate, stock to flow ratio of 100, then it will become the most scarce asset in the world, and probably also the most valuable asset with the highest market value, above 100 trillion US dollars, hence my name. So yeah, and that's where the stock to flow model sort of ends, right? That's where we have no data anymore. Then we're in terra incognita. We don't know what a stock to flow asset of 200 will be worth, and probably that means that asset will be the de facto money. And right now if we look at a chart on the y-axis, we denominate Bitcoin in dollars, but that will probably not make sense anymore at that time. And probably indeed the dollar might be replaced by something else, Bitcoin or the special drawing rights of the IMF or something else. And of course, all the gold investors hope that will be a gold-backed thing, gold-backed world currency. But I think there's a real chance that Bitcoin will be that better money, thermodynamically perfect money. And then of course, stock flow model is is done or must be changed, in that the dollar is not. We cannot measure it in dollars anymore, and Bitcoin should shift to the denominator of all other assets. And so really, really interesting times ahead.
The first model I published is the stock to flow model, and I guess that's where people know me from. That's Plan B is stock to flow, etc. So people are mentioning the stock to flow and are connecting everything I say to stock to flow. But in fact, I use three kinds of models, and stock to flow and the stock to flow cross asset model that came later. Those are what I call fundamental models. They try to on a fundamental level, not on a price level or based on something else, but based on some fundamental thing, scarcity in this case, say something about the value of Bitcoin. So stock to flow is the center, the core of all my modeling. That's true. But there are other models, and for example, the well-known technical analysis models, which are price driven. They're based on the Bitcoin price only, maybe some volume data, but I don't use that. So for example, an RSI, a relative strength index, would be a technical indicator, or a moving average. So the 200-week moving average is something that I use a lot and tweet a lot about. And my favorite technical analysis thing is my floor model that got a lot of attention lately as well, because it nailed three of the last months to the dot. But it's a bit in trouble right now. We'll probably talk about that later. But that's a floor model, and the third kind of models that I use is on-chain models, and that's something very specific for Bitcoin, because Bitcoin has the blockchain and all the transactions are in there, so everybody can analyze all the transactions that and all the blocks that come in every 10 minutes and see if it's big transactions or small transactions, old wallets selling, or new wallets selling, and those kind of patterns are very, very interesting. It takes a big computer, it takes a lot of data analysis skills to do it, but it's very exciting. And I must say, I spent most of my time, maybe 80% of my time, in that on-chain data analysis area. I'm an investor. I like models. I use all those three kinds of models. Fundamental models, stock to flow, for example, the technical models and on-chain models. And I think that's where a bit of the confusion comes from sometimes. But that's how it is.
Do you believe that any of your modeling is influencing the behavior of market participants out there?
Nah, not really. By now I'm a pretty large account, but not large enough to move markets. In fact, I think I had more impact on the markets when markets were a bit smaller, like 2 years ago or something. But no, I think it's much more fundamental than just an opinion or a model that someone that the market follows. I think there is greed and fear in people. That's just human behavior, and that will always be there. So it's very interesting to see that people like to buy Bitcoin when Bitcoin is going up, although prices are, of course, a lot higher than when Bitcoin went down. But when Bitcoin goes down, nobody wants to buy Bitcoin. There's always greed and fear, and you can model that, right? You can model that, and also there is momentum in the markets. That's one of the basic thing in all markets, also equity markets, bond markets, etc. That once a trend starts, there is momentum in that it goes on, and that could be because there's a large buyer in the market that cannot buy the exposure they want in one day or 1 week, so they need multiple weeks or months to build the exposure, and once once that gets going, then it will continue. And so the momentum is a very real thing in markets, which of course all the technical analysis is based, for a lot of technical analysis is based on. And then the really fundamental things for stocks, modeling the cash flows, the dividend flows is a very real thing. For derivatives markets, for example, options, which is basically a volatility market, modeling volatility is very real and very fundamental. It doesn't change.
So I wanted to turn now to the question of evaluation of these models, because assessed, and I remember one of our earlier conversations, you were saying, put in short terms, in simple terms, if Bitcoin is not over 100K by the end of this year, 2021, that you would then say, okay, that model is probably failed. Do you still hold that view, or has your view shifted here?
Yeah, and that's a bit of a short measure, or a bit of a simple measure, but yeah, I still hold that view. I think stock to flow is tracking very well since it was published in March 2019, when Bitcoin was below 4,000. So it tracked really well. It mainly predicted that the halving would trigger another, was not priced in and would trigger another bull run, which we saw. We're now sitting at a bit below 60. What is it, 57 or something thousand? So if you look at the charts, for example, this bot of Bitstein, which can be found on Twitter, it's the stock to flow multiple called S2F multiple, and it tracks the performance of the model on a daily basis. You can see that it tracks very well within most of the time within a 1 standard deviation band, and it went a little below the 1 standard deviation band into the 2 standard deviations band lately, but came back up from there, and we're now smack back in the 1 standard deviation band. So and going towards 100K. So yeah, I think it tracked well as advertised, and I'm very even I am a bit amazed by that, because the model should not work at all. In fact, right, the efficient market hypothesis, you cannot model the market. But I think the proof of the pudding, the real victory lap, or how do you call that, is when we cross that 100K barrier. I guess that's the thing, and I guess it's good to explain that when you read the article, when you see how the model is made, it's just a normal regression analysis. It's nothing spectacular, nothing exotic. It's very, very simple, one input variable. But what it basically says, it's after the 2020 halving, the price level should be on average for that halving period. So until 2024 should on average be $100,000. So that is the real proof or validation, if you will. If we track, if the data still fits that very simple linear regression, then it's all okay. But since technical analysis people somehow don't really understand the average linear regression thing, and are really used to think in levels and price targets, I shouldn't say dump that down, but I simplify that into if it should be 100K on average, then 1.5 year into the halving cycle, so 1.5 year after the last halving, it should at least cross that average of 100K, because otherwise it will be very difficult to be 100K on average. We should spend a lot of time above 100K to even make that average. So at some point we should cross that line, and I guess historically looking to last 2 bull runs, 2017 and 2013, that point is about 1.5 years after the halving. So that's how I came up with end of 2021. It should be above 100K, which is very short and snappy, and technical analysis people understand it. So it's really the average that you should be looking at, but the 100K is short and so the floor model got some attention. I guess it was June. I published that, and it's kind of a moving average, but then done otherwise, purely based on price, and it could very specifically point the minimum Bitcoin price at certain months, even like 5 months ahead. And 3 of those 5 months were spot on. Last month I missed, was a big miss. And this month, it doesn't look like I'm going to make it, but the floor model is still, in my eyes, a very useful model, very useful view.
Bitcoin has been in choppy water as we close out the year, currently sitting at around 46K. This is a far cry from the 135K end of year predicted by Plan B. In a recent 1.5-hour interview, Plan B touched on many topics, including his thoughts on the models he uses, leverage in the market, and the upcoming years for Bitcoin and ETFs. But of course, one question he cannot avoid of late is, what the hell happened to your model? While we have to give him the benefit of the doubt because December is not over, it's a high probability that his model will have woefully failed 2 consecutive months. Plan B explained why he thinks his model went wrong.
So what went wrong? Yeah, lots can go wrong. All models are wrong, and some are useful. George Box used to say that. It's a very famous saying. All models are wrong because they're simplifications of reality, but they can be very useful, like the navigation in your car, for example. It's not reality, but it brings you from A to B. And the same is true for models. So what went wrong in this model? Well, lots has happened, right? We have seen, since we last spoke, the Chinese mining ban. So half of the mining capacity was located in China. It was banned, and it relocated to all other places, the US among them. We have had an Omicron, a new COVID variant that gave some flashbacks to March 2020 when the market dipped to very low levels, including the Bitcoin price, and we've seen the Evergrande default now recently. So there's all sorts of news that sort of impacts this Bitcoin price that is, of course, not in the model. And one very important thing about the floor model miss of 98,000 in November is that this is a first time in 10 years that that we see this miss. So this model has, of course, in sample, so with hindsight, hold for 10 years. But now this is a first miss, and it could be an outlier. It could be a one-off or 2 months off, and then a sharp V-shaped recovery back to the model lines. Or it could be that the model is wrong, is off. Something changed. The model is not usable anymore. And I'm still not at that point of making that decision, whether the model is just off temporarily because of an outlier, a black swan, or whatever, or that the model can be thrown into the trash bin and is off structurally.
Plan B's models have been questioned by Bitcoin enthusiasts and investors after these past 2 months, to say the least. He was super bullish and still is, but in this interview, he also did touch on the fact that he is one of the few who believe that we will have a Bitcoin winter in 2022, and the 4-year cycle is not over. He was especially concerned about the winter after Bitcoin goes past the 100K price. And as much as he is not looking forward to it, it's just human nature, and we need to prepare.
First of all, I'm one of the few that indeed thinks that there will be a next bear market, a crash, like we've seen a couple times before. Because there's a lot of people right now saying that we're done with the 4-year cycle and we will not have that kind of volatility and that kind of deep bear markets anymore. I think we will have those bear markets. You can see it in the option prices. It's priced in at 100% volatility. You can see it, a couple of months ago when the China banned it, the mining, we went down 50% or more. So we almost had it. we had a crash of 50% right there. So that tells me that 80%, when something really big happens, is not out of the question yet. So yeah, I think we will have to go up quite a bit, at least to make the stock to flow model values of 100,000 and 288,000. But after that, we'll go down 80% again. And I'm not looking forward to that, to be honest. Nobody probably is, but I guess that's part of the deal, and it's also part of the greed and fear that's in investors, and that people won't change. There will be FOMO if we, for example, hit the 100,000 level a couple of months from now, or maybe this month, according to the stock to flow model. People will FOMO in, and it will go up, and then after that, something horrible happens, another ban, another China ban or India ban or something, and everybody's scared again, and the fear sets in. So I guess that fear and greed is never going away in Bitcoin.